Hey, good morning, everyone. Thank you for joining us for today's webinar, GST 2.0, the Great GST Reset. As you know, these changes come at a critical time and have far-reaching implications for businesses across sectors. In this session, we will discuss key areas on how the rate changes would impact your business, the compliance changes, and what the business will be required to do as a way forward so that organization can adapt to changes smoothly. We have a very engaging session ahead. With this, I would now invite our speaker, Sanjay Chhabria, to take the proceedings forward. On to you, Sanjay.
Thanks, Vartika. I hope I'm audible and my screen is visible.
Yes.
Thank you. Do we wait for a couple of minutes because I'm seeing that the participants are joining? If not, I can start over. Jiten, over to
So,
you.
Sanjay, I think we can wait for 2 minutes
Okay.
more. Yeah.
So I'll start maybe in the interim people can join because anyways I will start with the introduction.
Yeah, not an issue.
So hello friends, I think GST 2.0, and I was actually thinking from what exactly happens. Is it a reset? Are we looking at how the rates are changing? Are we looking at what is exactly happening? When we started looking at the fine prints, I think we started deep diving that it's not just a rate change. And, the things that are going to affect you is a lot more. There could be things on your cash flow. There could be things which are going to affect on your provisionings. There could be things which could maybe impact your litigations as well, maybe your current and maybe, future litigations. How are you doing compliances? How things flow through from ease of doing business and how, maybe your supply chain, does it require a rejig? In fact, there's a lot of hue and cry that we see at the worldwide. We may want to see that how this rate change is now going to help me with at least international markets restricting our products at least from US perspective or the other angle perspective that we try and look at. But would there be any benefit that India itself becomes my consumer here? So after 1st July 2017, this is the next revamp, and I am sure that we will continue to remember 3rd September 2025, which as the strong reform, which is actually bringing in a lot of such changes. So one reason I think of the rate recheck, which was more evident from the rates that we were trying to look at, is that they wanted to increase consumption within India because if I look at a 1.4 billion population, I have the largest, or the first largest, at least if I might say, the consumer market at an overall level. So why not encash that itself, at the first level? And that's where such rate reject could come through. And if you see, the timing is also in such a way that it's the first day of Navratri and maybe end of your Pitru Paksha, when everyone is generally has been deferring their purchases or the transaction that they want to do, and from the first day of Navratri all the purchases would happen for maybe the Dasera season or maybe even the Diwali season. So it's actually a double Diwali bonanza, and unlike, I think, never before it has happened that the Prime Minister himself has announced that there will be changes. So this is the first in its case, and I am sure that there are a lot of things at least to learn about. I would try and touch upon some of them, but yeah, there's a lot more to at least explore. One thing that they have mentioned is that such changes will have around 48,000 crore worth of effect on the GST collections. Overall, if I see, we are already at 21 lakh crore. So it's approximately 2% of the overall collections so far. And I am sure with the rate reduction, there will be a boost to the market, and there will be more GST collections that we will come through. And I should appreciate that the GST Council is now the new thing, at least for indirect tax professionals that we are, that we don't wait for the budgets. In fact, this was the 56th council meeting, and if I actually equate it maybe with the overall, weighted average, we see that, every 2, 3 months there is one GST council meeting which has happened, and there have been reforms would have changed a lot of laws, brought in a lot of notifications, brought in some clarifications, and I think more over and above. This one is pretty special to us, because it does bring in a lot more changes. So to start with, I will briefly touch upon the trade facilitation measures. So it's not just the rates that have been changed, but there are some facilitation measures that have been affecting so are more or less on the compliance overall, how things change, etc. That is what I would try and touch upon. Rate restructuring and its impact along with some sectoral implications. I will talk about in the service rates as well as goods rates rationalization, business readiness, and the way forward. So the practical implications would try and cover a lot more, at least around that. And if you have any queries, do put it up in the question box or the chat box which is available to you. I would maybe try and take it over at the end so that and answer any of the questions which come through. So to start with, this meeting was held in Delhi. Council replaced uh, the existing four-tier structure with a simplified rate to 5%, which is the merit rate, and the 18% making it the standard rate. There will be a 40% special demerit rate for selected goods, which could be pan masala and sector-wise specifically. And they've also mentioned that sector-wise rate list, which will come into effect, which is except the specific products of pan masala, gutka, cigarettes, and chewing tobacco, would be released by the CBIC in the due course. So we've not got the notifications yet, at least till the hour that I'm talking now. But we are hoping that the CBIC should put up those notifications. And 22nd September has been announced as the effective date. Council has also recommended key changes to the provisioning governing discounts, which is more or less to simplify a lot of the practice and the business realities, and also maybe some changes to the intermediary services, which is the highest, at least, at an overall level. So the at a 30,000 feet, the facilitation measures that they've specifically spoken about is the GST, the refund provisions that would go to a retweak, the place of supply for intermediary services specifically, the post-sale discounts, and refunds on low-value exports that they have at least given exemptions to. Simplified GST registrations for small, low, and small e-commerce suppliers. So to start with, the first good news that actually came through is that GSTAT will be operational for accepting appeals. So what does this mean? So by end of September, they have given a deadline that they will start accepting all your appeals. So if you've drafted and kept your appeals ready, it is the time that now you will start uploading them specifically for filing, or maybe at least move ahead with filing them specifically. They've also given a deadline that positively they will be commencing the hearing as well from December 25. So we are seeing that there is a ray of hope that the GS stat is going to, start. The tribunal will start, functioning from December 25 onwards. We will see a lot more changes also, in fact, in the due course when the tribunal starts giving out their own judgments and maybe orders which have been pending since the last 7, 8 years now, specifically that we try and talk about. So all pending appeals, one thing that the business should now look at is that you need to file all your pending appeals before 30th June 2026. So post that, I think, again, I think the time barring issue could apply. But the one date that is being specified is that if you start filing by September onwards, at least till 30th June, you may want to cover all your appeals which are to be filed or at least to be sanctioned. So now, as a way forward would be, if there is anything that you would want to appeal, you start rethinking, start, looking at so fill declarations. If at all you've done any pre-deposit for stay recovery, you should prepare to file the appeals, right now. And any pending writ petitions that you had before the High Court, or the High Court has dropped your or not accepted your writ petitions, you may want to start looking at that. Can we pick up this, filing for GSTAT appeal as well? Additional to GSTAT, they've also mentioned that the National Appellate Authority for Advanced Ruling will also be functional, and the principal bench of GSTAT will start acting as one in this area as well. So, both ways, I think, one reject the department or the GST has done is that they are bringing in the litigation, at least phenomenon, to start working on that. And from our perspective, we should start seeing that, if there's anything that we always wanted to warrant or appeal against, we should start looking at it and start filing the same. Second thing was mandatory sanction of risk-based provisional refund. So this is specifically applicable for zero-rated supply of goods and services, or both, or even for the inverted duty structure. Now, this would be effective from 1st November 2025. What does this actually mean is that 90% of your refund, which will be granted, now will be granted as provisional refund through system-based risk evaluation. So there may not be a departmental review or a full-fledged review which will require for such provisional grant of refunds, unless there is an exceptional, exceptions involved, like maybe there are reasons and there are detailed scrutiny required. More or less, your refund will be on a provisional refund will be on a fast track mode. Notification will be issued for specific categories which may not be eligible for such refunds. CBI will also inform the field, formations or grant provisional refunds for the inverted duty structure based on this. So what it intends is that the reform will help the business to unlock their working capital blockage. While there have been, with the rate revisions, there will be a working capital blockage. So to ease this out and maybe provide the money to the business so that they are able to use, they have moved to the early reset of the provisional refund. So available funds will enable business to meet their operational expenses or invest in the expansions or maybe global competitiveness, or go against with that. However, there is a catch here, and I keep telling a lot of my clients that provisional refund is always a double whammy, because while you get the money, if any of that is ineligible, and is or maybe partially ineligible, any excess amount recovered will have to be repaid back with interest. So therefore, now it warrants that your claims are correct. If 90% of your refund gets sanctioned, you may want to see that, okay, whatever you filed is at least 90% correct, so that whatever amount you get, you don't pay that interest at least on top of it. While I would prefer 100% correction, but eventually at least the error rate can only be like 10% at all, if that's requested. Moving on to the favorite topic, I think this has created a ruckus, and this has been, in fact, in the erstwhile regime. I might go back to the history. 2012 is when the place of provision of service rules introduced the concept of intermediary services. They, at that point of time, only covered services, to be part of the intermediary bracket. Later on in 2014, they introduced the intermediary concept to even goods, amending the definition and maybe saying that this is the concept where this would be, at least looked at from a third party, or creating place of provision within India, and maybe countering every export that is being made, and, from a company to their captive, or a company via the third person, which is actually involved. And it arose a lot of litigations, at least around that. The concept, after the GST introduction in 2017, the concept continued exactly in the same wordings, even in GST regime. And now that in 2025, which is after 13 years, the council has recommended that they do away with this, specific provision. In fact, I was recently reading the Supreme Court judgment on Vodafone India, It also may be specified and supported the framework which said that the recipient of service is the person who contractually is engaging the service provider. So somehow, getting this law itself, or omitting the 13(8)(b) specifically, would arise that what happens to the past litigation. So after this amendment, the place of supply of intermediary services will be the location of recipient. It will go back to Section 13, Clause 2. It will enable that most of the export benefits that were available for and maybe countered or denied due to the intermediary services will now be available to the exporter specifically. Um, so key legal issues that we look at, at least will arise, in the past that we were trying to look at is that are these services to foreign recipients, which is sales, marketing, central procurement, BPOs, etc., would they qualify for intermediary constitutional validity of 13(8)(b)? What applies? Is it IGST, CGST, SGST, disputes persisting to the GST Council? All of this now will come to rest, hopefully, going forward. But would this be prospective? I think we'll have to wait and watch till the final text is out. There's a lot of hue and cry because, with this being retrospective, there'll be a working capital effect to the revenue because there would be so many refunds which will suddenly get sanctioned. There'll be so many issues which will come to rest. And therefore, maybe the way at least the indications are, coming through, this may be more prospective as compared to retrospective. However, we'll have to still wait for the final, text which comes out in the due course, at least around that. Another thing, very important, a lot of FMCG sector or a lot of sectors which are actually affected by this was on the post-sale discount. So Section 15 and Section 34 have now been amended, wherein specifically the section 30, 15(3)(b)(1) is omitted, which uh, warranted that you establish the connection between your discounts through a pre-sale supply agreement or link your invoices. So there, this is no more required. And 15(3)(b)(r) Section 34 determines that the discounts must be granted via GST credit note. Recipient requires to reverse the ITC if supply is reduced. And maybe the Circular 212, which now stands withdrawn, specified the compliances mechanism around this space, around this. What are we looking at least as a clarity to come in the future, or at least by 22nd September or prior, is that the clarification reduces the post-sale discount, are the issues around it, which could be relating to whether any ITC reversal for financial or commercial credit notes is required, whether manufacturer to dealer discounts form additional consideration in the dealer customer transactions, whether post-sale discount amounts to consideration for promoting activities by dealer. Now, these three things are pretty much highly, highlighted, and there could be a lot more, at least to have a clarity. I'm hoping that the amendment will bring business a pass the post-sale discounts as incentive promotional schemes to the dealer and distributor. Implementation of, in fact, the IMS, which is around the corner, which could get mandated. It was imperative to have this robust accounting system or documentation or reporting process, and therefore this also comes as a benefit to the business that they are able to at least comply with the IMS as well, to get this at least out of their to-do list so that the credit notes and things actually get settled more further. Proper system and documentation will have to have a direct bearing on your ITC and your output tax liability as well. So a welcome move. At least this has also raised a lot of litigations. But with such omissions, I think we see that there will be a lot more litigation which could come to rest. Again, whether this is retrospective or prospective, we'll have to wait for the fine print to come out. one smaller thing may not be huge for a lot of businesses, but very effective for small exporters or maybe MSME exporters is that there is an amendment in Section 54, Clause 14, which now recommends to remove the threshold limit of 1,000 for refunds arising from exports. So you can now file a refund for as low as maybe even a 1 rupee, if required. And that's where you don't have to be, qualify for 1,000 rupees as such. And sometimes it actually does happen that every month on month are the computations that you do. There would be some places where you have a refund, some places where you don't. So this threshold removal does come as a benefit specifically for the courier and postal modes, at least, when we look at from an export perspective as well. GST registration scheme has been seen an overhaul where optional simplified GST registration is being introduced to streamline the process. The scheme now allows voluntary opting in as well as withdrawal. So opting for the scheme is an automated basis. Within 3 working days from the date of application, you should get the registration up and running. Scheme is more or less applicable to the low risk applicants as identified through system-based checks. There will be categories that they will try and roll out that these are the categories, at least through the notification that could come out. And maybe the system will also throw that, okay, that we, as an assessee, we or the applicant is a low risk applicant over here. The output tax liability in this case from the own assessment perspective to registration should not exceed 2.5 lakhs. And these are the applicants which will be applicable, this amendment could be applicable to. So the move is more to widen the taxpayer base. The businesses can benefit from the input tax credit on purchases because most of these registrants were earlier not provided registration, or the registrations were raised basis the issue of fraudulent activities or the maybe Hawks GST registration that we were looking at. With this move, at least there will be some simplification of GST registration even for the smallest low risk taxpayers or the small taxpayers that are looking for getting into the GST registration. Modalities are yet to be out. Once they are out, I think we would maybe take it up from 1st November 2025. Simplified registration again for small suppliers who are supplying through e-commerce. This introduction of this mechanism is would be for suppliers which are operating through e-commerce for multiple states and have maintained a principal place of business in each state where these supplies are being made. The modalities of implementation are still to be out, but this measure specifically eases out most of the small e-commerce players, cloud kitchen network, or any network which always was trying to get into various states and expand their expand their businesses into multi-state and have the registration. This would also reduce the cost and maybe encourage wider participation in digital marketplace. Moving on to rate rationalization, what we have done is, while I think it's there, it's been 7 days now since the rates have been modified. Uh, you may have already gone through most of these rates. So what we've done is that we've reclassified this into services as well as goods. And what I will do is maybe I'll skim through most of the key ones and not go a little detailed into the rates specifically. One thing which maybe I wanted to highlight is that CBIC is to issue the notification to validate these rates. The effective date so far that they mentioned, like I told before, is 22nd September. But the validity will only come through the notification once that is actually rolled out. So you may want to have a eye on the same, because these are all proposals that we are talking about. Whether the actual rate is implemented in the same way in notification is what we may want to look at as well. So for as a surprise, in fact, on services, the hue and cry was that there is a rate reduction on goods. There have been, reduction in a lot of such rates that we were trying to look at. But when we try to look at the services specifically, we were surprised at a larger scale here that suddenly there is an increase in rates as compared to what we were seeing earlier. Like for an example, air transport, other than the economy class or maybe passenger transport or renting of motor vehicles, which is where ITC is being availed, is suddenly jumped up to 18% as compared to 12%, while the 5% still continues. This could now, wherever the airline is trying to take the credit and they were following the 12% regime with the ITC, this will now bump up your prices by 6%. So it could raise your airline cost, tour operating cost, maybe rental fleets. Tourism sector would face a mixed impact. Some places when we talk about the hotels in the next slides, hotels could get cheaper at some places, but the transportation could be costlier over here. uh, Aligned to the air transport is the goods transport agency. Goods transport agency is also fallen in the same trap. Wherever there was 12% with ITC, suddenly that bump has come at 18% with ITC. 5% still continues as without ITC as the standard rate. In fact, wherever this was not applicable, like transport of goods and containers in railways did not have the 5% without ITC. They've introduced the same as well over here. So the rationalization here also could increase your logistics intensive industries, FMCG, pharma, exports, oil and gas. All this will have an effect, at least from this rate, wherever the logistics provider was utilizing 12% with ITC as a base. Another one is again local delivery services or delivery through e-commerce. This consistently stays at 18%, no change specifically. However, the job worker specifically has a reduction in rate over here. So 5% from what it was 12% earlier, now they come down to 5%. So rate cut would now support more of the MSMEs and the key labor intensive sectors. Could be the pharma, the leather, the printings, and maybe umbrellas and bricks or the and the whereabouts around that. Interestingly, construction sector has suddenly again seen a similar bump of 6%. So offshore work contracts for oil and gas, works contracts predominantly with earthworks, or maybe subcontractors or contractors for earthworks, as stated above, will have a 6% additional rate, which will be 18% with ITC. Again, affecting offshore oil and gas infrastructure. Government projects would have this effects. There could potentially be slowdown of investment because offset by budgetary support by governments could have a structure, could have a say on the structure of the rationalization as an effect. Maybe construction contracts could also have this kind of an effect because now suddenly SAC 9954 will be equated with most of your construction contracts that is available, and maybe every piecemeal will have to be looked at that what is being availed as 12% today will now move to 18% as compared to the without ITC regime. Like I spoke earlier, hotel accommodations, which was room tariff, which is less than 7,500 per night, now moves to 5%. So decrease in rates, more consumer friendly. While the hotels will lose their ITC, some hidden cost burden. Large hotel chains may feel the pinch because the white segment hotels or hospitality tourism will stand to gain at least with this reduction in 5%, and there is a 7% reduction in the rate tariff itself, which will come to you and would boost at least the hotel accommodation and maybe the tourism industry at large. So moving on to the affluent or biomedical or beauty wellness services or maybe even cinema tickets, these all will drop to 5% from what it was 12% earlier. This will give you a at least more footfall in the theaters, and then cinema going. Single screen theaters in small towns would primarily benefit at least from the lower tax rates, and multiplexes would face this pressure that there is a pricing strategy. One thing which I did notice is that while admission to casinos, race clubs, bookmarks, specified actionable claims, and luxury rentals were in the sin category, the sin sector category, where the rate was 28% and now it has moved to 40%. However, sporting events like IPL is also now being considered as a sin category over here, and they would also move to 40%. While they also gave a clear, reply in the FAQ that most of the claims, if there's anything which is lower than 500, we would want to look at the rate in a different pattern. But since if it is more than 500, then it actually moved into a sin category, and any event which is anything below 500, there is a different rate which is being prescribed. So government is trying to resolve citizens from financial ruin, social distress, and aligning the recently proposed promotion and regulation on online gaming bill with the aligned succession sector to bring it into the higher risk rate category. Now looking at the oil and gas mining and petroleum crude, specifically on this side, this is also bumped to 18%. Um, uh, Benefit now comes to the individual health and life insurance. Yeah, mind the word that it is for individual, and maybe third party insurance of goods and carriages. So individual health and life insurance moves from 18% to exempt, and third party insurance of goods and services moves to 5%. So this exemption of health and life insurance would make policies more affordable. Coverage, and especially for middle class families, will boost at least the coverages around that. It will also benefit corporates from obtaining the group health policies for the employees. And since ITC won't be available, insurance companies may face higher costs, which could lead to a premium hikes as well. Moving to goods, in this area that so for fertilizer sector that we look at, the GST rate will lower the production cost for the fertilizers. It would ease working capital needs, also encourage use of sustainable agri inputs. So if you see sulfur, ammonia, biopesticides, rare tractor tires, and some parts of the tire, tractors also suddenly have dropped to 5% as a new rate. Interesting point on the renewable energy. Solar water heater specific renewable energy devices now have moved from 12% to 5% as earlier. The issue that this industry was earlier facing is that there used to be an inverted duty structure because their inputs were generally sold at 18% or 12%, depending on the rate that they were specified, and even the rates on the services that were being provided to these sectors from job work perspective or installation perspective again was at a higher rate. So bringing down the rate from 12% to 5%, suddenly there's going to be a larger hit on them, that there is an inverted duty sector. In fact, the FAQ also clearly mentioned that this sector would face the inverted duty regime, and maybe will have to be looked at that the refunds are being at least taken by them. And they've also mentioned in the FAQ that while this is going to affect the sector, they have at least got the faster refunds, which is in the earlier slide that I spoke about, that provisional refunds will be sanctioned earlier, so that this working capital blockage should at least be exempted for all the inverted duty structures, which are at least going to face this kind of an issue. Another area which most of the consumer electronics sector would look at is the air conditioning, dishwashers, and televisions will drop to 18%, which should drive a lot of sales growth during the Diwali season, because there has been a lot of sales which actually come out during this stage during this time. So you will see that along with this sale, a 10% reduction in rates would make these products more affordable, at least for tier 2 and tier 3 markets as well. Leather sector or sand lime bricks again dropped their rates to 5% from what it was at 12% earlier. Portland cement again to 18% on this area. Agricultural sector has also seen a larger drop here, from the engines to the horticulture, soil preparation, cultivation, the harvestings, or even the trailers, whatever was used for under Chapter 84, Chapter 87 specifically has now moved to 5%. So um, the GST cut on the farm machinery or irrigation system or tractors will reduce the cost on the farmers, would promote more mechanization. If the farmers were planning to buy any of these tractors, they will be able to modernize their irrigation use and also raise the productivity and support sustainability. Common man items, which was being looked at and spoken about even during the GST Council, was that safety mattresses, tableware, kitchenware, sewing machines, bicycles, part and accessories of bicycles, combs, etc. All the household material will now drop to 5%, likely to boost the demand, help MSME and local markets, rural market opportunities to be improved. And if you look at the other areas, in fact, photographic plates, photo for X-rays or cinematic graphic films, or even other than the feature films as well, will now drop to 5%. Glasses for corrective spectacles and flint buttons, this and contact lenses specifically, um, will drop to 5%. Smoking, a cigar, anyways, it's in sin category, therefore they've increased the rates to 40%. Now, in the health sector, when we look at life-saving drugs was at 12% and 5%, and this is more a welcome move because they were moving a lot more such drugs from general drugs to life-saving drugs. In fact, COVID was one larger example when a lot of the drugs that we were using during COVID moved to life-saving drugs and therefore had a reduced rate. Now this rate will suddenly turn to nil. So whatever is life-saving, may not have a GST at least applicable, which is covered under the HSN 30. Chapter 30. Medicaments and diagnostic kits, medical instruments, X-ray apparatus, thermometers, all of this will now move to 5% as well. Textile sector, synthetic yarn or man-made staple carpets, all of this will be 5%. Surprisingly, I was expecting that the apparel would drop to 5%, but they've kept the rate or the rate per piece, which was earlier rupees 1,000 to now 2,500. So the rate will now increase, on the apparel and clothing if at all you're buying anything beyond 2,500 to 18%. So there'll be a 6% bump that which is going to come on the clothing which is going to come through. So your Diwali bonanza would be applicable only if your per piece price is below 2,500, which I think is the MSME sector or the small sector that we are trying to look at. But the larger brands and larger purchases that you may want to do, which is more than 2,500 for footwear as well as articles of apparel, will have a 6% additional rate which could be applicable. Food sector specifically, we saw that the UHT milk, which was not earlier covered by the other products, is now also brought into the exemption category. Paratha, cheese, sugar boiled confectionaries, pasta, and a lot other have dropped their rates from what was originally say at 18% to nil or 12% to 5%. One thing you will note that fruit pulp or fruit-based juice drinks would also be, at 5%. But if any of these waters are containing sugar or caffeinated beverages or any non-alcoholic beverages as well, this will now be considered as sin goods and would be bumped to 40%. While there was already a cess which was applicable on this because this was already considered as sin goods. In fact, when I see the global practice, I think every location is talking about this in goods and trying to tax them at a higher rate to restrict the consumption of sugar. So eventually, I see that Dubai has a separate, tax category, and maybe other countries also do have a similar tax category taxing the sugar content specifically. So I think India is following the same when they introduce the cess. They continue to follow the highest sin rate for all these areas as well. Transport sector again drops to 18%, which is rubber, road tractor, motor vehicles for the transport of 10 or more persons, motor vehicles driven by petrol, diesel, CNG, parts and accessories of motor vehicles, and engine capacity more, which is 350 cc will be at 18%. Motor vehicles of engine capacity exceeding 1200 cc or length would move to 40% as a rate. In fact, the existing rate with the cess along with goes up to 50%. So this is more a 10% drop while we look at it as an increase in the base rate, but the overall rate there is a reduction of at least 10% that we look at. So it's again a welcome move, at least from their angle as well. Other areas could be handicraft sector, coal, footwear, all durable articles have and have seen reduction, except coal has an increase in this rate. The question that was specifically asked on FAQ is that if the rate of coal is now increased from 5% to 18%, would this bump even the energy or electricity rate specifically? What the response was specifically provided is that while the base rate was 5%, there was already a cess which added the value to 18%. So the rate has now been brought with the cess being eradicated. It has been brought to the linear level. So there may not be increase in the electricity rates that you would be looking at least in this regard. Tobacco products, the BD wrappers are now reduced to 5%, BD reduced to 18%, and manufactured and unmanufactured tobacco, cigars, tobacco containing products is now at 40% slab rates. Moving on to practical implications. So, while there have been such rate changes, in fact, I want to spend more time on these practical implications here specifically. So, to start with, the update in GST rates in accounting or ERP system, inward and outward, in rates will specifically mean that you will have to change the rates in your accounting systems or maybe your ERP systems, both from inward and outward. Revise most of your POs or maybe issue new POs, or even in some places, if you have any contracts which are inclusive of rates, you may want to cancel those contracts and enter into new contracts wherever required. So this activity will not just be a rate change activity. It will also mean that you would look at your contracts, existing contracts, and try and see how you revamp them with the new rates, have some negotiations with your vendors, and maybe even wherever this benefit is now being passed on to you, so that at least this is available. Second thing, when we look at revisiting your cost structure, which is on goods and services, and ensure that the benefits are passed on to the consumers. This one again is hinting towards anti-profiteering. In fact, to highlight, there was the notification 19/2024, which was released in 24, specifically added a sunset on the clause of anti-profiteering, and it mentioned that no application for examination will be accepted after 1st April 2025. However, Section 171 continued to stay unchanged. Now, the issue with such revisions, the question that was arising, that can the department come and challenge the rates or reduction in your rates from anti-profiteering? There are potential avenues that the department can take, while they can always say that the sunset was only for filing complaints. But Section 171 is still applicable and is still active. Therefore, there will be anti-profiting applicable to you as well. There could also be that they might say that the action of recovery could not just be from GST perspective, but also from the Consumer Protection Act, which is 2019, reincarnated at that time. So these two legislations could be there. In fact, I am seeing such change in rates, because the competitive market, the industry at large itself is only going to push you to reduction of the rates, because we've already seen this in the auto industry where the rates are already being dropped, and there have been larger concessions which are being passed on to the consumer. So if you don't do it on your own, I think your industry, where from competitive market perspective, unless you are a monopolistic product, will enforce you to drop your rates as well. So revisit your cost structure. I think this will ensure that the benefits and maybe complying with the current rates is actually applicable to you. Third was on post-sale or post-supply discount. So downward adjustment pertaining to the whole supplies, GST credit notes would continue. So for an example, if there is a downward adjustment in the supplies which was made earlier, through a credit note or maybe through a revision in your rates or any knockoff of your earlier transaction which is being done in the current year, you may want to do this with the old rates only. So that's what would be applicable here. In fact, the provisions of post-supply discount which is being removed. So your linkages of while the fine print is yet to be out, but your linkages will have to be at least not be made specifically in this regard. Any upward adjustments pertaining to your old supplies will have to go through the debit note at new rate only. So why? Because a new invoice is being issued or a new debit note is being issued instead of your old debit note. I will come to the slide what exactly applies and when. Maybe in the subsequent slide I'm talking more about the time of supply. That will also give you what is the tax rate that is applicable, at least from that angle. Treatment of stock lying with your distributors or your CFA, and would also have some implication that the company may have want to engage and assure that there is no financial loss or implication going to the reduction in rates. The ITC claimed on the inventory bought, which was at higher rates, would still be available for utilization. So one thing, first come first is that you don't have to write off your ITC which you've claimed. The same will be available for your utilization. Alternatively, a balanced compensation solution may be agreed upon by way of commercial credit notes to neutralize this. Or it could also mean that you maintain transparency with proper records and avoid disputes later, so that any of your contracts which needs to be revisited, your tax clauses needs to be renegotiated, or any rates that needs to be renegotiated, use this as a benefit of rate reduction or any amendment as for your benefit, and maybe those discussions might be undertaken now. Fourth point is the sixth point is on the implementation of time of supply. So in generally, the time of supply has three categories, which is the actual supply, your date of invoice and payment. This determines what is the rate that will be applicable to you. Just to simplify this, what I have done is that bifurcated this into two categories. One is goods which are supplied prior to 22nd September, and goods which are supplied after 22nd September. We are assuming that the effective date of the rate would be 22nd September as announced. If the notification says a different date, please look at that, and maybe you can replace the date here as well along with that. So if your goods are supplied before, your invoice is before and payment is received before, you will apply the old rate. However, if your goods have been supplied before, your invoice is received after 22nd September and payment is also received after 22nd September, that will be a new rate. And if I look at the other way around, that if your goods are supplied after 22nd September, but the invoice and payments were already received. So in case of advances, etc., that you would have already received prior itself, or maybe invoice also you would have received, you will still continue to have the old rate over here. So this more or less simplifies any of your issues on what happens if I have received advance, what happens if I have received part payments, what happens if I have received overall payment, specifically on this angle. All this gets clarified at least through these combination that we've tried to put it over here. One practical implication, which a lot of people had an issue, and during the council meeting, in fact, the Honorable Finance Minister did mention that they will come out with a clarification, and they came out with one last evening, specifically, and I had some time to at least capture that. So, any declaration on so if because of the MR, change in rate, the question is that do I change my MRP on the product? They have specifically mentioned that the declaration on the face value in lieu of such changes will have to be done through stamping or re-stickering, on the product, on the MRP. Reliance, while looking at the anti-profiteering, the secretary did mention that Reliance will be paid on the trade and industry that the same is passed on. In line with that, the clarification is issued that any reduction in rate will, eventually lead to reduction in the MRP that you are looking at, and therefore these will be corrected. So how would you do this is that your new price should not be overwritten. So your old price and new price should be visible on your product. Manufacturers, packers, importers, all shall be able to, will be required to make at least two advertisements in newspapers as well as circulate notices regarding the rate reduction. And one more benefit for the industry at large, because it's overnight and you would have so many wrappers, packaging material with old rates, so that you don't lose the cost of it and you don't have to write them all off. The benefit is passed that you are allowed to sell the goods with the old MRP till 31st December with restamping and restickering. So you don't need to reprint everything and get get all your products back from wherever they are lying with your distributors, sellers, retailers, or maybe even the final sellers. You just have to change the rate by restamping, restickering, or maybe stamping the same, and maybe showing both the rates, that what was old and what is new. And this will be able, you will be able to revise the MRP revisions right away. One question that a lot of affected industries have is that my earlier rate was 18%, 12%, now it is at 5%. Earlier it was 40% or 28%, now it is at 18%. Am I eligible for refund, or, and because it is creating an inverted duty structure, because I bought it at 18, now I'm selling at, say 5 for an example, or I bought it at 28, now I'm selling at 18. So when I looked at the FAQ specifically mentioned about that the registered person, the input and outputs attracting different tax rates at different point in time do not get covered in clause 2 of the first proviso to section 54(3). What it means to say here is that the rate at different point of times is different, but does not create an inverted duty structure. So here the credit has to be accumulated on account of rate of tax on inputs. If you look at section 54, it says your inputs, the tax rate on inputs should be higher than your tax on your output supplies, and not the same supplies that you are trying to supply. This was also countered with the circular 135, which they referred is that refund is not available if your input and output are same but attract different rates at different points. This is on the left hand side. Now, this is, if I look at a conservative view and what the government is trying to say, and if you actually maybe try and go and talk to any officer, I think he's going to give you the same story of the all the three, things which are in green. But for the industry at large and maybe consultants specifically, we do have a lot of plethora of judgments. In fact, there are several High Court judgments that I looked at. It is Delhi High Court, Rajasthan High Court, Kerala High Court, Madras High Court, and also when I look at the other two, which is Calcutta and Guwahati High Court, have specifically spoken on this, in detail, and have been at least talking about that such refund should be eligible. In fact, I'll read out the wordings of BMG Informatics, which says that the provision of para 3.2 of circular 135, which I was referring on this, provided that even though different tax rates may be attracted at different point of time, but the refund of accumulated unutilized tax credit will not be available under section 54 in cases where outputs and supplies are same, would have to be ignored. This is what the High Court is trying to say as Guwahati. Again, in Shivako Associates, they have specifically mentioned that the circular is trying to create a class inside the class which is impermissible. According to the Act, refund is permissible in respect of all classes where the input tax is higher than the output tax. And by way of circular, the board is curtailing the said benefit and making refund permissible only if the input out and output supplies are different. So this amounts to more outreaching. In fact, I have plethora of such judgments, which we are looking at. So if I think, any of the industry would like to go for a, maybe an advocacy or even challenge this specifically, maybe file a refund and then challenge the refund rejections in the High Court. I think this is the way forward that you may want to do. If not, there will continue to be an accumulation of credit. And unless we do not have a clarity, at least in this regard, if you want to be on the conservative side, you may want to accumulate your ITC and continue with the same. If you want to be on a little aggressive side, I would suggest that, if you would want to challenge the same in the high courts, I think we should get some relief in the coming months or in the coming years, whichever we have to see. Final practical implication that we look at, while I mentioned earlier, the base rule is if your products are not exempted, credit will be available for subsequent periods for your other products, unless it is stated otherwise. So you don't have to write off your credits, you don't have to reverse your credits. If you have an eligible credit and your products are not exempted, you should continue to host the same. If your product becomes exempted, assume you have just one product and it has now turned into an exempted from 22nd October. The bad news is that since you do not have any other taxable supply, the ITC on this may have to be reversed under Section 18 plus 4. But if you have other products, then you go to point number 9, where you could still kind of sustain those credits and being available for the subsequent periods. So this is a very important clarification. This is what you may want to at least exercise before 22nd September. Try and analyze how many exam categories, what is the reduction, etc. that is actually applicable to you. 11th is on the compensation shares. Now the thing is that, like for an example, the comp sesh was applicable on coal and a lot of automotive sector that I looked at from cars perspective. What happens now? Do I go ahead and take a refund of the same? Do I need to reverse the compensation cess which is there applicable to me on inputs? What happen, because I don't have an output liability, because compensation cess came with a clarification that you can utilize compensation cess against compensation cess only. In fact, the question was raised with the revenue secretary during the meeting that what happens to this. He had clearly mentioned that the same will have to be reversed and will become a cost to the industry. However, we would want to wait for the clarification to come out. I think once the rates are out and some clarifications are out, we should be able to look at it in detail. But as on today, if as a suggestion that I will say is that hold on to your ITC till some clarification is out. If we get the clarification that okay, it needs to be reversed or any clarity on this regard that can be utilized elsewhere, you can at least try sustaining that in your books of accounts. If not, at that point of time, you may want to reverse the same. On the other hand, pan masala, gutka, etc., will still have the compensation shares as 18%, and there will not be an effect, at least from accumulations of the compensation shares on this sector. Any sale before 22nd September but received after 22nd September. The question which was raised is that when I sell before 22nd September, assuming that I removed my goods on 21st September with the old rates, but by the time the goods reached the destination, it was already 23rd or 24th September. Do I need to amend my e-way bill or cancel my e-way bill? The answer is no. The FAQ is also holding against us and saying that, okay, we will be able to sustain the same. Another point that I'm trying to highlight, which I did in the earlier segment, was that do see that are any of your products attracting inverted duty structure. I'll give you an example like most of your packaging material, which is corrugated boxes or things like that, is now at 5%. But the paper which is utilized to make those corrugated boxes is now at 18%. So if you are maybe manufacturing any of your packaging product at your end itself, you may be in the structure of an IDS, and maybe you'll be able to claim a refund. Similarly, when I look at the renewable energy sector, which I actually spoke about earlier, is that the output rate in future is getting dropped at say 5%, but the inputs are still continued at 18%. So there is an inverted duty structure applicable. So there will be more avenues where you will be able to encash your cash flows, which are now being stuck. So do look at this specifically area as a benefit. Another thing which I look at is that because of the rate reduction, your state incentives, the subsidies, or any central incentives, any of this, if it is linked to your GST payments, will now have a, will get reduced and will be, affected as well. So whatever cash flows you would be looking at, or as an avenue that there will be an amount which will be paid to you, you may want to at least recalculate all of this and try and look at that, what amount is going to be now paid to you going forward, at least on the GST payment that would be made, which is at reduced rate. Finally, the end use rate rules. While the government has mentioned that we are going away from such practice of end use rates, but the litigations in this regards, I don't think so is going to get restricted. We would see more of such end use rates coming in, being, and there could be higher rates or lower rates, depending on what you do. Like oxygen, if it is used for healthcare sector, I think there will be a reduced rate. But if this is used for manufacturing purposes, you might see that okay, there could be an 18% that could be challenged. So we are hoping to see. I think tough times are great times ahead. But before I go, I think GST 2.0 is a 9-yard reality check. It demands agility across supply chain, technology, revisiting cash flows, provisions, and disputes. So I would not just suggest change of rates. Please look at it at a 9-yard reality check. It would mean a supply chain rejig. It would mean your technology changes. It would mean that your cash flows, which is now being accumulated, will have to be rechecked. That if there are any provisions to be provided, any write-offs to be done, that also needs to be looked at in detail. Any disputes that need to be, undergo will also have to be looked at. Before I move into the question around, I would want to pass on the credits to Aditya, Siddharth, Geetanjali, and Jui. These are my next time minds, who worked for this presentation. I think whatever we are there today with the smallest of changes being brought in, I don't think so this would have been possible without them. But yeah, I pass on my, regards to them and moving to the questions now.
Thank you, Sanjay, for this insightful presentation.
Yeah.
We
So I
can have
have
the
few
question from the
questions here.
Q&A.
I will, yeah, I'll take it up. Um, while PPT, I think we will try and share after the webinar. The first question is any impact on cost of goods for EPC business, as we don't find due to the GST to wherever rate reduced will affect only on the cash flow as we purchase goods at the basic price. So what I feel is that the rate reduction is there on the on certain category of the EPC businesses. There will be an effect which will be there, and if I have to go specific into the products, I may have to look at each product of the business that you are actually into. But yeah, we the rate reductions will affect your cash flow. There have been reductions on one side, whereas there have been places where they are allowing ITC with a increase in rates as well. So I am sure that okay, there will be an effect on that, but a granular review of the products will have to be seen, from each product HSN wise, and maybe the details whether ITC is available, not available specifically on this regard. Question from Nikita is that how will insurance cut benefit to corporates? We understand that corporates avail insurance premium will continue to be subject to 18% tax. So here what we were trying to say is that when the insurance cuts is actually happening from healthcare as well as maybe the life insurance, which is for individual perspective, the corporates can would say the tax is not on the corporate that they are trying to avail. It is more on the employees that we are trying to look at. So your tax rates that I am trying to talk about is that if I was passing on these rates in the name of these individuals specifically, the rate reduction will happen, at their end where the cost is being, borne by the corporate but being paid for the individual itself. So that's the benefit that will actually get affected for the corporates. Whereas if the way that you are maybe, undertaking this specific segment is the direct contract on your own behalf and then passing it on to your employees, I think that may have to be relooked at specifically on that angle. Any rate change, again, 3304 mentioned at 5% for talcum powder, face powder, but there are many such items which fall under the same chapter. So like I did mention, we'll have to wait for the, the granular changes that would come through. whatever we were able to add this is, at a very 30,000 feet high, and it's already 7 days, past. So I am sure all of you would have already had those, rate changes in this regard. So you may want to look at them. And once the notification comes out, I think we'll have a more threadbare detailing of what is the revised rate, what are the chapter headings, what are new publications, etc. So, Hitendra, all your 3 or 4 questions are in same line. You may want to look at the same. And yeah, PPT would be shared after the call, after our things. Queries from Siddharth here is that what if packaging is ready but manufacturing is going to happen say after 22nd? Can we use the old packaging with mention of revised, which I think already covered? Is it mandatory to reduce the ultimate selling price even if current before GST revision the products are being sold at discounted price? Post the change in rates, a mandate is there that you would change your pricing pre rate change. If you would want to change your selling price, the issue that would come through is that that is more a business decision. But because of the GST revision, if your products which are being sold now at a lesser rate, which is today, let me put it in this way: my MRP already has say a 1,000 rupee value, which is now crossed and said at that I'm selling at 800 rupees as on today. Tomorrow after the rate change, you may want to do another cross and show that okay, there is a rate reduction, and because of which there is say a 10% further reduction, which would be say 720 for an example. So those kind of things will have to be done. I already spoke about the revision on the Legal Metrology Act. I think you need to show both the rates. So in this case, all the 3 rates will have to be shown that there are rate reductions 3 times, at least 2 times, so that anti-profiteering is not applicable to you. So all the rate revisions that I see as a question, I think you may want to refer the fine print. You would get, I think, most of them from there itself. Owing to what we can do here, Jitendra, is that we can have all the questions copied, and maybe we can directly drop an email to people providing these answers because we've already surpassed our time. Most of the questions are more on the rate specifically that I look at. So we can move on. Jitendra,
Sure,
over to
sir.
you.
Thank you. Thank you for this insightful session. Uh, Participants, if you still have any question, we welcome you to reach out us at thinknext@nexttime.com, and our team would be happy to respond offline. Thank you for joining us. Have a great day. Thank you, Sanjay sir.
Thank you.